All right, we're going live. We're good. Good on YouTube. We good on Facebook? All right. Ladies and gentlemen, ultimate consistency, the art of buying the dip. What is the difference between buying the dip and catching a falling knife? Don't they seem a little contradictory? There's actually a major difference, and I'm going to go through that and some trades we took today. I am Mark Melnick, and this is the Newsbeat Show. Good evening, ladies and gentlemen. Welcome to the Newsbeat Show. I have so many great things to talk about here today, and let's just get right into it. By watching this show, you are agreeing to hold me, Mark Melnick, and T3 Live, harmless and not responsible for anything. Pause that slide, watch it. Let's get right into the action. Okay, so it's kind of funny when people talk about generalizations in the market. You've probably heard don't catch a falling knife, but isn't it a little bit ironic because you're supposed to also buy the dips, sell the pops, buy the dips, sell the pops, but don't catch a falling knife. And I want to sort of educate you on the difference today and how we caught them today in the market, and just show you, how we batted, perfectly today in the market. Market players lose probably, I would say, more money from improperly buying dips than any other action, because what usually happens is when they buy the dip is they keep averaging down into a stock that keeps falling, for example. They get too big and too fast, and they just hit a point where their pain threshold is just too much and they can't withstand the pain anymore and they sell out, often to see their stock come back, and then they're all mad and then they suffer even worse toxicity. I am pretty sure traders who've been trading for more than 5 years can relate to something like that. You know, it's extremely easy to be undisciplined in buying dips and pullbacks, and the losses can be huge, especially when your thesis proves incorrect. However, dip buying, when done right, and I'm going to show you today how I do it right, can produce really nice, consistent gains. And some of the best opportunities in the market are stocks that are being quote unquote, I don't even want to use the word unfairly sold, but more like overreactioned, an overreaction for it being sold. Now, most people, they'll look at, a chart and they'll show you volume and they'll say, look, there was high volume here, and then the volume's going to dip and it's going to go down, and you could short the quote unquote moving train, or you'll see, the large volume bar head down and you could buy the dip. It's a little bit more complex than that. And if your goal is consistency and you want to get away from all the other rooms 43, 57 paradigms that they put you in, it's very important that you do exactly what I'm going to show you today. And I'm sure there are other ways to do it, but the point is going to be crystal clear, and you'll be able to master this sort of buying the dips or shorting the tops. So the first thing you have to, when you're becoming sort of a master of dip buying, as I like to call it, the first thing you need to understand are the different basic types of pullbacks. Okay. The first type of pullback is an index driven pullback. And this is going to be very important, and really pay close attention to this one. This is going to be very important here. And, you know, index driven pullback. And the important thing about an index driven pullback here is that it's actually the market itself which is going down. And these are basically dips that are actively traded by computer algorithms, dips in the QQQ or the spiders or the IWM, etc., 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 which are robots selling off a security. Now, these are the ones I like to avoid. I generally avoid these on individual names unless I can accurately call, and we do it how many hundreds of times a year in the Newsbeat live room, right? Unless I can accurately call a bottom of the market. So, for example, let's say I come to you and I'm like, okay, well, I see the Qs and the spiders, they're all falling, but I want to buy Apple today for whatever reason. So I'm watching the Qs and spiders, and I know as soon as the Qs and spiders stop going down, 98, 99% of the time when they start going back up, Apple as well as 50,000 other names will start heading higher as well. So, you know, traders often actually refer to this as the 10th a dip in the market as like the 1030 dip because it has become so automatic. The computer algorithms pounce on these plays, which often are very small, but this is the bread and butter of much of the programmed trading that occurs every day in the market. And very complex algorithms are employed for this sort of dip buying, and the programs will use news headlines number one, two, and three. News drives the market more than anything else, not your charts, not the silly moving averages that we use, not all the other things. And I say silly, and look, I understand they all have their place. Here's me with my four moving averages and Bollinger Bands and trend lines and volume and candlesticks. Like here's me doing it. So very important to note, like it all has its time and place. Overall, it's a very different type of trading when you're buying a pullback in dips in individual stocks. If you looked at the market today, if you even looked at the market today, we were in one extremely tight range. Short of a false print there, we were actually in a dollar for a range. You could see we're up after hours as news came out literally after 6:30 today, p.m. Eastern Standard, that the US might get rid of tariffs on China. So as you could see, the market just boom exploded up after hours, whether you watch again the Qs or the spiders. And even if you look like at an Apple, like you could see how Apple reacted after 6:30. You can see how well, Goldman Sachs actually doesn't really trade much after hours, but you could see like how a Bank of America went up after 6:30, how a Facebook went up after 6:30. It's very common that when the market moves up, and everything moves up with you. Now, I did a video over the weekend that I thought was very important that you saw. It was my afternoon video on Sunday, which basically described my Know Your Limit 21 strategy, where I gave you four simple rules. Choose an earnings name with a gap up, happens after 10:30 a.m. If it hits a 21 EMA on a 5 minute for the first time, buy it. Very, very simple strategy. And I'm going to show you what we did today. So this is how we combine the news flow with bottom picking. Now pay attention because I think we're going to be able to do stuff like this all week. So McDonald's today, if you haven't heard the story of McDonald's, why it gapped down tremendously today. I mean, almost $4, just short of $4 today, is that the CEO was having a very consensual relationship with a subordinate. That goes against McDonald's policy in terms of relationships between management and other people in the company. And the CEO decided to step down and resign. Now, what happened was, and this is going to be very important for how we caught the dip today in McDonald's, is you obviously see somebody knew that the CEO was stupping whoever he was stupping well before, because McDonald's started dropping here on practically no news. People were looking at McDonald's thinking like, what on earth is happening here? So the stock went from basically $210 all the way down to 187 today. So literally McDonald's dropped 22 and a half points since October 21st, when the market has been pretty much going straight up since October 21st. And whether you're watching the Qs or spiders, the whole markets have been going up since then. So somebody obviously was shorting McDonald's or buying tons of puts in McDonald's based off the fact that they knew that story was about to go public. McDonald's board management definitely knew about it. He definitely met with board management. There are obviously leaks to people who had very good information on this company and acted upon it and shorted the stock. So the first thing I was thinking today in the morning when the news came out for all us mortals to find this out is that McDonald's seems a little overdone for me. Now, what was I going to do with McDonald's now that it just seemed overdone? Well, I really set out my game plan every single day on Twitter and in the Newsbeat live room. We share it here. And it basically says, besides for the two names, I was watching Blackberry and Marvell for long. It says, all days are not created equally. Don't really like much at all today. Take it slow, please. Tear down. May try my new version of the Know Your Limit KYL 21. So if you actually look at the top right here, after I say good morning, bandits, mixing it up, try to buy names on pullbacks was my strategy today. So what I did here was I noticed that there was an algorithmic support right by $190.07, an algorithmic trendline support, which McDonald's should bounce from. However, if it flushes through that level early, it would be a good buying opportunity for me. So I was waiting for McDonald's to go down. So here's just showing you a simple 5-minute chart of McDonald's in the morning. It flushed down to 188.37. I threw in a bid for McDonald's calls. I believe I got filled at a dollar. I got filled at $1.33 on the 190 calls. Again, if you're buying common stock, whatever, you made money that way. I got filled on 190 McDonald calls at $1.33. The day low at that point, when I bought McDonald's in the morning, the low of those calls were $1.25. I was down literally. I bought them 8 cents off the dead bottom. Immediately after, it hits 188.37 on the next 5-minute bar. It literally jumps up $1.51. 10 minutes later, it's making day highs. This move, you want to know what made McDonald's for me? That. Just that. Flush down. I knew it was a buying opportunity because I knew the McDonald's news was already priced in because it was plummeting before. Somebody was already reacting on that news. And considering that it pulled back and the market wasn't plummeting. So again, going back to the triple Qs, this is what the triple Qs were doing, or whatever you prefer, the spiders. They weren't really going down that much, right? They're pretty much holding up. So right over here, you could see the Qs are going pretty much up here. Again, whether you're using that or the spiders, they weren't dipping down this hard. So it got an initial sell-off. Immediately, the Newsbeat live room is buying McDonald's at the dead lows. At the dead lows, immediately. Our focus. Hundreds of traders had their days over at that exact juncture. Hundreds of traders were like, that's it. Those calls went from $1.33 to $2 in no time. I didn't sell $2, I think. I forgot exactly where I sold. Nowhere near $2, but made the quick money and moved on. Next, there was a stock Lululemon. Now the interest, and I'm just going through the trades. Now you see Lululemon. The interesting thing about Lululemon was that it was actually upgraded today. I know this is very small font here, but I could read it to you if you can't see it for whatever reason. It says Lululemon price target raised to $230 from $210 at Wells Fargo. That came out this morning in the pre-market. So the way I'm seeing Lulu here is I want to buy it on a pullback, but the question is, well, where would I buy it on a pullback? So what I do is from straight out of my algo course, I draw an algo buster reversal level. I get an algorithmic support of right near 196.40s, and when translated on a 5-minute chart here, I see that the algorithmic support is right near the 196.60s. So this whole time, as it's dipping down, I'm looking to buy Lulu. Why? Why am I looking to buy Lulu? Because the market isn't plummeting to cause such a down move in Lulu. So that's how I judge overreacting. There's only positive news out on Lulu. It was upgraded. So then when I draw a support level, it's most likely going to work. And a lot of traders did really well on this today. So you could see this yellow line. Forget all the other stuff except for this yellow trend line. Maybe I could just show you on the one chart on Lululemon. I'll even, yeah. So right over here, you could see this yellow trend line. Lululemon falls right here. I buy in 197.5 calls. The stock literally bounces $2 in almost no time flat, right? And we're buying down here on the bid. We're buying down here on the bid. Immediately, Lulu bounces $2. trade over, trade over. So at that point, I used an algorithmic trend line. On McDonald's, I also used an algorithmic trend line. Now let me show you what I actually did to call the Roku bottom today. So Roku was falling today, and we called the dead bottom range right here. Oh, my head's blocking it, sorry. Roku was falling today, and we called the dead bottom range right here. Now, I knew Roku is reporting earnings. I know Roku is definitely a stock that has rallied phenomenally off this recent low range when it was trading in the low hundreds over there, between 100 and 105. And it's rallied magnificently, and it just started selling off today, seemingly random. Now, the first thing I do is I look for news flow. Is there any news flow that is causing Roku to drop like this? And the answer is no. No, there isn't. There isn't any news flow that's negative for Roku. So right out of the master class today, I use my S3 support as the key level to buy Roku, saying that I want to see it flush through 138.36 and then break $138. And if it breaks $138, I'll go ahead and buy it. What happened? Roku goes ahead, breaks $138, and the Newsbeat live room is buying in right over there. Now, it's not just about the money. You might say, okay, look, there's a million trades that make money. You're missing the point if you think that these trades and the intention and purposes of these trades was to see how much money you would make. That is never the goal. That is never the goal. You want to make $1 million trading? Don't look at your P&Ls. Just look at the trades and get rid of your psychological toxicity. Trust me. That's all you really need to ultimately do. That is how traders in the Newsbeat live room become millionaires, by following that mentality. And they'll all the traders who are making those seven-figure years, they do come back to me and they tell me that same thing. They're like, Mark, you are 100% right. Just don't focus on the P&L. Just do the right thing at the right time and just let all the chips fall in place. That's all you have to do to be successful. Now, granted, you need to understand, strategy is all you have to do. That's a broad generalization. You need an internet connection and whatever. Point being here is there was no toxicity. You know how it feels like to buy a position and to be down a lot of money? So what we were doing is we were putting risk aversity first. We did not want to lose money no matter what. We wanted to be up money no matter what. So we're sitting there and we're fighting and fighting for the best trades possible. How many traders out there sometimes get caught in what I like to call a market order rut, where they keep using market orders to buy and sell securities as opposed to limits? That is an extremely that can backfire upon your face so hard by doing that. That can backfire on you so hard. So I know again I was really working over this weekend to find a strategy like this because again, I know I keep referring to him because honestly, he inspired me to start doing this. I mean, see, trading strategies are basically inspirationally based. People don't realize that. They think it's just all these candlestick formations and, a couple moving averages and whatnot that will do it. And yes, they are important. And I use everything that you see in my chart, I can make money off of consistently. I get it. Trust me, I know the powers of technical analysis. But I will tell you, um, from the man that inspired me to, stay up, pretty much to like weird hours in the AM morning trying to develop these strategies and tweak these strategies. He inspired me, the quadriplegic member who joined the room, who has such a blessed goal, who just wants to do great for his wife, who, you know, God knows how much work she has to do now, and God bless her. And I'm just sitting here thinking to myself, how can I make this man's journey as a trader better? And I've been sitting there all night and I didn't hang out with my friends on Friday night. I just literally stayed in front of my computer to develop this strategy, and a lot of you guys haven't seen it. It's actually, well, I'm sure a lot of you guys have also seen it. It's literally Newsbeat Show 462. Um, it's literally Newsbeat Show 462 right here. Definitely check it out. It's right over here, as you can see. See earnings strategy, know your limit 21. So there was a trade today in which we called in it was race, and it was boring and it was profitable because today was a very boring day. The Qs were pretty much in the tightest range all year. A dollar for a range, I believe, was the range of the Qs. I think that's the tightest range all year, if I'm not mistaken. Definitely one of if it isn't. And it basically says take an earnings name that gapped up, race reported earnings today. If it hits this blue line after 10:30, buy it. I'll even show you on the one chart to make it easier. Race gaps up. This is Ferrari race. Gaps up on earnings. If it hits the blue line for the first time after 10:30, buy it. I know. I made it. It I know it sounds crazy, but do you realize how long this actually took me to create? Do you realize how many I spent at least 20 hours over the weekend? Doesn't sound like a lot, but I have two young kids that I have to take care of. I have a ton of responsibilities. I spent 20 hours to give you, I don't even consider line 4 a full line. To make these 3 lines for you took me 20 hours to create. And the one setup that we liked today that had it, the only one we called was race Ferrari. Look how beautiful. You buy it underneath the exponential 21. Why underneath? Why not at? Because that is the way we say it. The 21 EMA right here has to go under for the first time. Under. It goes under the 21 EMA. Under. And you could see right here, this blue line, it goes underneath here. We step in, buy the stock, easy money. I missed this one. I threw in a bid and didn't get filled. But a lot of traders in the room got it. You know why? Because that's true transparency. Me telling you exactly what I'm going to do, where I'm throwing a bid, what I'm doing before I do it as often as I can. As often as I can. Right? You can't do it on breaking news ideas. The guys, I have to buy this thing right now. Whoa! I can't really sit there and. But trades like this are slow. Now, you might be saying, why on earth, Mark, would you design a strategy like this for somebody who's quadriplegic as a trader? And the answer is because I felt a lot of the strategies I do are very high octane and they work out brilliantly. And a lot of traders are supporting their families on these strategies that I actually wanted to just take a full 180-degree turn and actually show you what a low octane strategy is. Boring and beautiful on every sense of the word. Buy right on the blue line, just like this shows you. And look at that. Stock goes from 170.58 all the way to 172.03, about $1.50. Easy, easy, easy money. Low risk, low stress, completely stress-free trades are buying on these pullbacks. And we were doing them all day. All day we were doing these trades. You see, ladies and gentlemen, a lot of traders look at the support and resistance lines on their charts and they have no idea why sometimes it's just, you ever notice how many, type in 11, type in me right now if this is something you've noticed as a trader over time. Sometimes your technical parameters work brilliantly and you'll get a streak of like, oh, look, it bounces here, it makes sense. And then all of a sudden it'll just stop working like altogether. You'll be like 75% right and then you'll be like 25% right. And you'll have no idea why that happens. Has anybody noticed that? Well, congratulations, because it took me 2015, 15 and a half, 16 years as an active intraday trader to realize why that was happening. And then, of course, you'll get the people who are delusional who will tell you, well, it doesn't work. Look, here's a moving average. It breaks through, it goes down, it breaks, it hits it, it bounces, it makes no sense. Then, of course, I give a little bit of a deep breath and I have to say, well, there actually is a reason of why it's working. And there are market environments that are more conducive to that working. So when I'm sitting here and I'm looking to buy the Lulu or the McDonald's, there was news that I thought was being overreaction. It was an overreaction. The Lulu had an upgrade. The McDonald's dropped 15 points into the big CEO shtup of the century, where we finally realized that the CEO was having a consensual relation with a subordinate employee. And by just combining that news together and then applying the technicals I use, because I guarantee you right now, ladies and gentlemen, it's not just about the. Do you think it matters that I'm showing you these technicals? And maybe the trend lines really do matter a lot because we are calling the dead bottoms of names. But I'm telling you as a generalization, this is working for probably the majority of the technicals that you're using. What I'm saying is if I don't use Fibonacci. I don't use Elliott wave. I don't use 99.99% of the indicators in existence. But what I'm saying is if you combine the mentality with your parameters and what I am saying with these names, taking an upgraded name that pulled back. I mean, it's kind of funny because if I actually asked you the question, you would give me exactly the answers I'm giving you. I'll prove it to you. I'll prove it to you right now. You guys ready for this test? I'll prove it to you. And if I'm wrong, say, Mark, you were wrong. Seriously, you ready? You want to buy a stock, let's say. Okay? Do you want the stock to have upgrade bullish news, bearish news, or no news? Choose one. You're buying a stock. You get to choose one of the three. Bullish news, bearish news, or no news? Which one? Obviously, you're all going to say bullish news. Kelly, Truett, Alex, go in the corner with Pat. You obviously wanted to have bullish news. Okay? Now, when you're buying this stock with bullish news, that you want to buy a stock, all right, you said you wanted bullish news. Do you want to be buying the stock as it's ripping through day highs, moving sideways, or pulling back to a support level at a cheaper price? In English, do you want to pay more or less for that name? And you're all going to say, less. I want to pay less for that name. Okay. So you want to pay less and you want good news. Now, do you want the market moving higher when you buy it, grinding sideways when you buy it, or dipping lower when you buy it? What do you want to do as you're buying this stock? What do you want the Qs or the spiders or the IWM or whatever indicator you're using that correlates with whatever stock you want? What do you want the market to? You want the market to be going higher while you're doing it. You want to know what stood true on every idea we did today? It was pretty much following everything I just told you. It was pretty much following exactly that. So why wouldn't you strictly and only look for that? They say there are plenty of fish in the sea when referring to the stock market ideas or referring to partners that you might be looking to do whatever you want to do with. There are many fish in the sea. They say, "Oh, don't worry about your breakup. There are many fish in the sea. Don't worry about the trade you missed. There are many fish in the sea." So if there's so many fish in the sea, wouldn't you want to look for the best opportunity possible? And the obvious answer is yes. The more interesting question is why don't traders do it? And the reason why traders don't do it is because they are so blinded by either their previous experiences or the talking head or guru in which they're following that they actually become blind to what they should actually intelligently do. And if you're willing to look and never settle for anything and only looking for the best, becoming a successful trader is honestly easy. And I never thought I would ever say trading is easy because I was stuck in the 43.57 paradigm. And as I was saying today, when you have a strategy that works 30% of the time, it's better than a strategy that works 43 to 57% of the time. Because when you have a strategy that works 30% of the time, you're more likely to drop it and not follow it. The problem is psychologically, humans cannot discern what's happening, what's good and bad when they have a 43 to 57% paradigm. When you keep pulling the slot machine and it spits out coins and you lose coins and it spits out coins and you lose coins, you don't even know what's happening anymore. You actually confused your own brain. So I encourage you, run away. Run away from the nonsense that you've been doing before. Follow a community that's going to instill these principles in you and actually show you trades that can be high octane and trades that, like I'm showing you here, that can be very low octane, profitable, and consistent. And thank you. Thank you. Thank everybody watching here because it's you guys that make the Newsbeat Live Room T3 Live's #1 largest and fastest growing trading room. Happy trading, make money. I'll see you guys tomorrow on the Newsbeat Live trading broadcast. Interested in joining the room? First time bandits? Link in the description. Have a wonderful evening. Thumbs up this video if you liked it.